Hello students and welcome to the lecture. So students, as we know that we are covering the financial system and basically what we are doing, we are covering the mutual funds, right? That is the topic we are discussing about. In the mutual funds, basically you could say that these are the subtopics we have scheduled for the discussion. Like we will start with the introduction part, basic history, growth of mutual fund industry, types of mutual funds, regulation, investor participation, and the conclusion. Okay, so these are the subtopics we have scheduled for the discussion. All right, and what are the topics we have covered so far? Like we have done with the introduction, basic history, growth of mutual funds. Okay, and what topic we had started for the discussion? Types of mutual funds. All right, and what topics we are totally left with? We are left with the regulations, the investor participation, and the conclusion. Okay, so that is the scenario, that is the picture we have created so far. So let's start from where we had left in the previous lecture. So ETF we had completed. Now another type we have the open-ended funds. Okay, like what do you mean by the open-ended funds? Open-ended funds do not having. Okay, there is a one thing which I would like to tell you before we go further. Like remember we had a NAV in the previous lecture. Okay, I had told you the full form of NAV. Now is the question for you. Let's tell me what is the full form of NAV. You having 10 seconds to think, then I will give you the answer and your time starts now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. The time's up. So what is the full form of NAV? So basically NAV stands for net asset value. Okay, net asset value. That is the full form of NAV. Okay, and which type of mutual fund calculated at NAV? That's also I had told you. Again 10 seconds I'm providing you to think and answer, then I will give you the answer. So your time starts now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. The time's up. The correct answer is index funds, right? Index funds are basically the funds which are calculated at NAV in the end of the day. So now the question is, what do you mean by the NAV? What is the full form of NAV we had seen? Now what is the meaning of it? So NAV you could say basically it's a total value of assets, okay, including shareholdings, cash deposits, or other assets. Okay, and minus, subtract any liability divided by outstanding. Okay, so this is the net asset value. It's the total value of assets including shareholding, cash deposit or other assets, and minus or subtract any liability and divided by outstanding. Okay, so for example you could say, suppose if there is any AMC. AMC stands for asset management company. Okay, so now what is the situation? Let's assume the asset management company or the AMC having the total worth or holdings of rupees 100 crores. Okay. Thereafter, the expenses or the liabilities is 5 crores. All right. And the last one is total outstanding is 10 crores. All right. So that is the picture we have created. Okay. Now come back to the formal definition. What does it say? It's a total value of assets, including the shareholding, cash deposits, or the other assets. Total value is 100 crores we have created. Then minus or subtract any liability. Liability is 5 crores divided by outstanding. Outstanding is 10 crores. So formula, what is the formula? 100 minus 5 divided by 10, right? Total assets minus liabilities divided by outstanding. So 9.50 crores will be the net asset value. Okay, that is called the net asset value. It means that whatever the outstanding the AMC is having, out of this 9.50 is the net asset value. It means that per asset this value they have getting. This is also called as an average of the value. All right. So here you are required to just not only, you can say that, remember the definition, but also remember the formula. Okay. Even you could you can say that you can note down this example. For this, I'm providing you 15 seconds to note down, and your time starts now. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. The time's up. Okay. So that is called ETFs. Now, another one, we have the open-ended funds. So what do you mean by them? Let's understand. Open-ended funds do not have a fixed number of shares. They continuously issue new shares to investors and redeem existing shares based on the fund's net asset value. NAV. First thing we have noticed. These funds typically invest in diversified portfolio of securities such as stocks, bond, or a mix of both according to a specific investment objective or strategy. Investors can buy or sell shares directly from the fund at the NAV, calculated based on the value of fund assets minus its liability, which we have already seen. Redemption, investors can redeem their shares at any time, and the fund is required to buy back the shares at the NAV, ensuring liquidity for investors. Management, actively managed by the professional portfolios managers who make investment decisions based on the fund's objectives and the market conditions. Okay. Too fast we have. Okay. So right now, just finding out the points. First is unlimited access of share launching. Second is redemption or buyback at NAV. Third is diversification of investments. Okay, so these are the three main points which we have drawn from this, you can say, the paragraphs. First is the unlimited access of the share launching. It means that when we talk about the open-ended share, or you can say open-ended fund. Okay, so any AMC which is launching the open-ended funds, they do not having any restrictions on the share launching. It means that suppose if they had launched the 100 shares, okay, out of 100 shares, now they want to launch 50 more shares. Okay, then 50 more shares or 100 shares more. Alright, so what is happening here? Now you could see that there is no restrictions. Like there is nothing like that. If they had launched the 100 shares, then they could not launch the shares further. Okay, they could actively launch the shares into the market. That's why it is known as the open-ended. 100 shares, 50 shares, and the 100 shares. Okay, so they are launching the shares continuously. That's the first thing we have seen. Third, let's understand third thing first, then we will go back to the second thing. Diversification of investment. It means that whatsoever money they have generated, for example, suppose by merging all of them, they had generated rupees 250 crores. How much? 250 crores they have generated. Alright. So this 250 crores could be invested into the various shares, various debentures, bonds, other type of securities. Alright. So here they offers you the diversification of investment. Now the second point is the redemption or the buyback at the NAV. Okay. So that suppose you could say that was the open-ended fund. Alright. And in the open-ended fund, what happened? That suppose they had launched the 100 crores, or you can say not 100 crores, they had launched the 100 shares for funding. Got it? First picture. And this is for the time period of January to July. Alright. Now you are the investor. As an investor, suppose you had generated 40 shares. Alright. But what happened? That you are not finding yourself capable to go with these 40 shares for this month, or you can say for the time period of 6 months. Alright. You are unable to do this. So what happened? That you decided that once you reached April, what you will do? You will sell out these shares. Okay. So here is two options. Here is two options available for you. Outsider or redemption. Okay. Then it means that if you sell out these 40 shares to someone else, okay, the outsider. So the person whom you had sold the shares will become the part of this open-ended fund and you will exit from it. Okay. Second is redemption. Suppose you are not finding anyone who is willing to buy these 40 shares. Then what should do in this such kind of situation? So you could sell the shares back to the open-ended fund. Okay. It means that the AMC which had launched these 100 shares, you could sell the 40 shares back to them, and this process we called as a redemption. Okay. But remember, that process will not be carried out on the actual price. Okay. Doesn't mean that you will get the actual price. For example, suppose if the actual price was rupees 10 crores at per share. That's the actual price. But the redemption will always be done on the NAV. Okay? It means that you will be always entitled to receive the net asset value of the asset during the time of redemption. So, suppose when you were trying to sell it out, the NAV was only rupees 8 crores at per share. Alright, it means that the open-ended funds and the AMC which had issued it is entitled and it's ready to repurchase the shares from you, but on one condition, that the shares will not be redeemed on the actual price but on the NAV. This NAV may be higher or may be lower. Okay, so that's how the open-ended shares works. Okay, the open-ended shares having the unlimited access of the share launching, they could launch as many shares they want to. They could redeem or buy back the shares from the investor at NAV. They diversify the investment into the various areas. Okay, and if we talk about the management, then basically they are actively managed by the professional portfolio managers. Alright, so that is the thing. Thereafter, now we have the closely ended funds. First is the structure. Closely ended funds issue a fixed number of shares through an IPO, after which the shares are traded on the stock exchange. Like about IPO, we had discussed that the IPO always launch in the primary market, right? Primary market means for the first time the shares launched for general public or outsiders. Okay, so when we talk about the close-ended funds, then these are much like the IPO. Okay, after which the shares are traded on the stock exchange. It means that when you launch the IPO, you are launching the fixed number of shares. Okay, launching the fixed number of shares. All right. Similarly, when you launch the closed-ended funds, you always launching the fixed number of shares. Okay. So, suppose if you have launched the $500 shares, then it means that you are not, you can say, permitted or not supposed to launch the more shares. Okay, so like the IPO, the shares will be fixed, but they will be traded on the stock exchange. Got it? This is the structure. Investment strategy. Like open-ended funds, close-ended funds invest in the portfolio of the securities, but they are not obligated to buy back shares from the investors. Like we had seen that if this is an investor, okay, who had purchased the shares from January to July, okay, but once he reached the April, he is not willingly to stay in the open-ended shares and he want to exit. All right. So in such a situation, we had seen that there are, you could say, the two options: the outsiders and the redemption. Right. That's what we had seen. So basically, if someone from outside is buying the, you can say, the shares and participating into the fund, then the investor could be free. But if no outsider is approaching, then the investor could redeem the share by selling it back to the AMC, okay, or you can see the asset management company. It means that the AMC is generally obligated to buy back the shares. All right, that's the thing. Got it? But here comes the close-ended funds. Okay, the close-ended funds does not having any things like this one. Like they having no option of the redemption. Basically, it means that they are not obligated to buy back the shares. Got it? So if you have purchased a share from January to July, you have to wait till the July. Okay? Because in between, the company will not buy back the shares. Shares of the close-ended funds are bought and sold on the secondary market, where their prices is determined by the supply and the demand and may trade at a premium or discount to the fund's net asset value. Okay? So basically what we had seen when the shares was launched, they were launched as an IPO, so that like the primary market, and these were limited in numbers. Got it? But like an IPO, after some time they are trading into the secondary market, okay, where their demand and supply determine that whether they will be sell out at the premium or the discount. Okay, this is the thing. Now here we have find out two new words. First is premium, second is discount, right? Now the question is, what is the meaning of the premium or the discount? Okay, that is the main thing. So basically here we had seen that the demand and supply is basically the main factor which determine that whether the thing will be at premium or discount, or whether the prices goes up or high. So if we go by this, then first is the premium. Okay, so you could say when the market price of an asset or security is higher than the net asset value. Okay, which means that the investor or buyer paying more for security than underlying value. So when the market price of an asset or security is higher than the NAV, which means that the investor or the buyer paying more for security than underlying value. For example, suppose if the total NAV of anything or the any security is only 45. Okay, or you could call it as a 45,000. But the market price stands at 50,000. Then what is happening here? There is a total difference of rupees 5,000, right? It means that 5,000 is the excess amount the investor or the buyer is paying for the security. All right. Thereafter, if we talk about the another one, which is the discount. Okay. Discount means when the market value of an asset or security is lower than the NAV, which means that the buyer or investor paying less for an asset than the underlying value. When the market value of an asset or security is lower than the NAV, which means that the buyer or the investor paying less for an asset than the underlying value. Okay, not then. For example, suppose the NAV is rupees 50,000, but the MP is rupees 45,000. So, how much difference has been created here? Rupees 5,000 difference has been created here. It means that the rupees 5,000 is the lower amount the buyer or the investor has paid. Okay, so for which it has been created. So this is basically created through the condition of demand and supply. Okay, so if we connect this thing with here, so what we will see that when the demand of some particular, you can say the asset or the security is higher, but the supply is lower, then what will happen? The prices will be goes up. So it doesn't matter what is the NAV, whether the NAV is 45,000 or what, the market price will always be higher than it. So here we have seen the NAV was just only 45,000, but the market price is 50,000, which means that there is an excess of 5,000 amount, right? Similarly, if we come here, so suppose if the demand for any security is lower, okay, but the supply is higher. Okay, so what will happen? That the prices will be come down. So the same thing is happening here. Doesn't matter what is the NAV. NAV is 50,000, but due to the over excess supply, the market price is just only 45,000. Okay, so that's how the premium or the discount works. So students, basically in this lecture we have, you could say that, covered till now. In the next lecture we will continue from here. Till then, just revise all the facts and figures we have discussed in this lecture. Be ready for the another lecture. With this note, let's end this lecture. And what do we say? We say thank you.